Alright guys, glad to have you on board again today. I wanted to do kind of an in-depth version review of this model of mine, which I'm particularly proud of, and well, some of you who know me know that I very rarely brag myself for the work that I do. But this one I think could be very helpful for the general crypto community, mostly the investor type, which anyway are the only ones remaining at that time of the bear market. But here we go. So you're all pretty familiar with this model if you've been following this channel for quite some time. I've been using it quite a lot into my modeling system for market share distribution and potential venture in the crypto world. And actually, well, today as I was looking at it, just had another interesting idea to add on top of it, and reason leading me to believe that, well, I think more than anything else, this model is more than appropriate in the current context. And now let me argue about why I do think it is. Well, I just kind of figured out that I've randomly started plotting those dots on these things, trying to figure out how I could organize some thoughts. And then, as I did, well, actually it turns out that I figured out there was kind of a sequence or a pattern repeating itself, and that, well, the actual trade-offs that they were made by different types of project leading in certain type market shares were actually not just randomly distributed. There was a kind of this repeating system that says, well, the kind of trade-off that is made is repetitive, and it tends to organize in pairs. Like there are two competitors who make different types of trade-offs in a similarly typed axis level. What I'm mentioning in here is that, well, for those who knew that model, this is where it becomes new, because I actually, when I was looking at it, can't explain that, it just came out to me this way, but feels pretty damn logical. Actually, you're all familiar with these Trilemma blockchain stuff that's Vitalik just pulled out years ago. I actually said this problem will likely be solved over time. Well, it turns out to me it's an unsolvable problem, and that's the reason why it's been called a trilemma, by the way. But the thing is, well, I've always thought we would just move around the problem and just basically adding some more complexity to it, meaning that the initial problem might sound and look like it's solved, but actually we just move it around by different trade-offs. And by that I mean, well, the reason why this model started from just me trying to organize ID and trying to figure out that actually this thing organized itself only in a dual pattern sequence. And then figuring out that the different trade-offs, basically the pattern is pretty simple. It means that if you're on an axis in here, in order to maximize your distribution around that axis, okay, what I've done is to use the typical parallel system distribution, which basically is referring to every market share distribution in the world where there are dominant actors and the like. When in here we're talking about a decentralized alternative blockchain technology of use cases, and in that type of stuff, well, I hardly imagine that there will be different distributions of market share. There will be a dominant market participant and follow through like a second in line, and then a third one, and the rest is basically minority. So in that sense, well, if we use that parallel type Pareto distribution, well, you have no way to just be the best at everything. So what I'm always trying to highlight in the early building of that system, which say, okay, if one tries to maximize its points expenditure, let's call it that way. I use it as points, okay? This will be 1 to 6, and I will be say, okay, you can have only 1 6, then 1 5, 1 4, 1 3, 1 2, 1 1 on this parallel power type distribution. And how could I organize this thing? By figuring out 6 angles, which are the market shares that I initially highlighted, and to say, well, how could I distribute the points in a way that makes sense? Like if I had to note each and every type consensus, general consensus type that we know of today, and if I had to rank them on that 1 to 6 scale, following that parallel distribution on each and every one of these potential further market shares, then is this thing doable? And if it does, is it a logical sense to it? That was the initial question. Turns out, well, there is, and this is what the end of it just showed up, just looked like. And to explain to random people who are not familiar with this thing, what actually this is really what I just mentioned. This is a 1 to 6 points, and that means each and every consensus type, which I've named this as to be this, but of course, I mean, these are market shares, so they could change. But what I say is that this is the logical way in which the market, divided by SIB stack market shares, would organize itself organically to distribute into maximizing one axis distribution, given it that one asset has its 6 points. This is the leader market share. It has more than half of, for example, privacy or whatever. And in order to maximize, that means the second in line, it's 5. This fifth point would have to be on the same axis. That means, well, the one that has a 6 has a 5 on the opposite direction. That's the prerequisite for this model to say, if we want to maximize verticalization market shares around these 3 axes, which is basically security, scalability, and decentralization, blockchain trilemma. So like I said, I think the blockchain trilemma hasn't disappeared. It's just that different trade-offs have been made by different projects trying to maximize one of these 3. But in order to do it, they built in pairs. And in order to similarly differentiate these 2, we look at the different trade-offs that they made. Okay? That means, well, in order to maximize TVL, there were different trade-offs made for decentralization and scalability. And we would see that those who try to maximize their security access, be it, to me, Bitcoin and Ethereum, they maximize their security collateral system. That means Bitcoin is a store of value and Ethereum is kind of a collateral money system for digital money, for digital assets. So that's basically a digital asset wallet collateral. So in that sense, well, we see that they have made different trade-offs to achieve this. One is particularly maximizing its average transaction value, that will be Bitcoin, and the other one, on the other hand, maximizes total value locked, which is kind of external value that you're storing on your own blockchain. It means your consensus is not only storing its own tokens value collateral, it's also collateral for other assets, and it's getting exported elsewhere. It's kind of really the way it goes. And therefore, you're maximizing the security access by compromising one of these 2. One is going to maximize its internal value storage, the other one is going to maximize its external value, the external collateral distribution. That's really the way it goes, okay? So that's the security access to me. When we look at scalability access, which has been to me the major driver for the cycle that we've just went through, 2021, I mean, you're all familiar with the full of shit investments in Solanas and the like, which have caused severe price distortions. But on the other hand, it still means, well, the consensus type itself, the proof of history and sharded type execution, which we've seen in discussions in Ethereum, and I doubt it will ever end up being true, or not in the form in which it is. I'm generally tend to call like probabilistic distribution type of consensus. Like in this area, we would be talking about eventually avalanche as well. There are kind of different types of trade-offs in terms of the way the consensus is reached. But proof of history to me definitely stands out for the rest of the crowd of those probabilistic consensus. So I would like to say it's still very young and early stage to consider that proof of history in Solana therefore has won the battle of TPS, because just like I said, I think on the security end of the battle, it's won already in a matter that one competitor has managed to significantly increase its market share of 50% when the second one is barely fighting against with 30%. That to me has been settled already for the security access, meaning that in terms of average transaction value, I hardly see anyone being able to take over on Bitcoin, though everything is still possible, but very, 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 very unlikely at that stage, meaning that more than half of the transacted value in a particular token inside its own ecosystem, that's pretty much, I mean, the overwhelming majority for Bitcoin. That's really the way it goes. When it comes to the total value log, and on this end, we've seen many, many, many competitor projects trying to eat away on Ethereum's, but the hand is that, well, Ethereum just took it all back. And now we've got layer 2 scaling, and that's basically the way it goes. They're scaling and using the collateral security of Ethereum into secondary market level shares. So that's really the way it goes. To me, there's a really hard way for any competitor to try doing such collateral distributive value of security. So to me, Ethereum won that battle. It's probably going to be very well confirmed by the next cycle. But until then, well, let's just call it speculative. But I think these are the least 2 speculative assets. As the crypto sector matures, we can hardly argue on the Bitcoin to lose its market share. And I very well tend to believe that it just takes yet another cycle to confirm Ethereum. But to me, it's already settled. Though the question is, we've spent quite some time on the last cycle trying to figure out a potential winner for 10 transactions per second, even though I personally agree on Solana to be the winner for this. It's still, once again, going to have to be confirmed by further down the line cycles. The easier and the sooner you go down this curve, of course, the higher the risk, but the higher the return for the trader who's taking those risks. That's really the way it goes on a simple trading perspective. But the way it goes, well, to me, is Ethereum is here, Solana and proof of history will be maximizing transactions per second in a scalability axis. Other scalable solution that tend to be winning, as well as Solana, which means to me, that's really, I don't particularly say this one is a checked box already, but I would like to say, well, the daily active users, those who are maximizing scalability by onboarding users. And there are really different types of trade-offs. Like I said, they may look similar types of metrics to measure scalability of a network. You will look at the transactions per second, the pure verticality of one system, and on the other hand, the capacity to maintain users. And to have eventually users doing fewer transactions, but there are more users than another network who will maximize extracting transaction of a single user. And this is a very significant difference between the two. That means one will have very active individual users, the other one will maximize user onboarding, not necessarily trying to extract as many transactions from the one. And there are the different types of trade-offs. And like I said, this follows the same pattern. That means if you want one to be the 6th point of one, it will be the 5th of the other one. That means you can't just maximize scalability by just maximizing transactions per second. You also need to try maximizing your daily active users. It's really a balance that you need to strike to get the best at doing one. You need to be the second in line to do the other one. And that's really balance itself. And this means different trade-offs will be made. The winner of TPS will be the second in line in daily active user onboarding. And on the other hand, it will do different trade-offs for the remaining 4 axes. This is really important for you to understand. This is where the pattern repeats itself. If you look at the vertical, this horizontal axis, you will see that this one distributes this way. That means it will totally trade off interoperability and daily active users for the benefits of it's actually not this. It's to say the 2 major trade-offs are made to the consequent line of the number 6 points. All right, the things you're the best at, the next 2 consecutive things will be your worst potential elements. Okay, that means point 6 is here, though point 1 is always here or here. It's really the way it goes. Okay. And then that means point 2 is also here. It's just point 1 and 2. The list viable market share of your actual consensus usage will be following and right next to the one that maximizes. And on the other hand, you will distribute point 3 and 4 into the opposite angle. Okay, so basically that gives you this thing. And you see that the parallel distribution makes it that way. That means, for example, for Bitcoin, the maximum trade-off, the thing in which Bitcoin is the least good at, is transactions per second. I mean, everyone would agree it's the slowest ever blockchain and probably forever will be. On the other hand, there is a significant trade-off for interoperability. I mean, you hardly will see Bitcoin interoperating with other systems. There will be external usage of Bitcoins, meaning that it is still 1% of cross-chain transactions that will involve Bitcoin, but personally, I think it will be no such a thing. Most of Bitcoin will be potentially inscriptions. That means other blockchain using the Bitcoin security by storing some data in here, encrypted and compressed data eventually. Many projects are talking about it at the moment. But despite that, to me, that's really going to be the end of it. There are hardly going to be Bitcoin circulating on other networks, all these bridges and stuff. Well, when the security will increase significantly enough, the gap will be way too big. The value will be stored in Bitcoin and nowhere else, period. So to me, that's the assumption that's made. That means, well, point 3 and 4, these are referencing 3 to 10% market share. There's still significant existence for these markets. That means Bitcoin is very good at onboarding daily users, okay? That's really the way it goes. It will be good at bringing daily active users. The question is, do you think it will be even better at preserving privacy? My personal assumption on this model is that, well, to me, Bitcoin is very likely going to be much better at preserving privacy than it will be at onboarding daily users. It does bring significant users. What this model will say is that in the end, pretty much 3% of every crypto user will have been onboarded by Bitcoin itself. That's kind of seems significant. Remember, we're talking about full adoption. Every human on Earth using cryptocurrencies, knowingly or not. 3% of them are expected for me to be coming from Bitcoin. The others, well, they will eventually come from other assets at later maturities. They will possibly hold Bitcoin as well, but this is not the reason why they join crypto. That's what I think. You could argue about that, of course. On the end, I think privacy is going to be one of major capacity for Bitcoin that others will actually struggle to get a lot. Because remember, if we look at it through the lenses of the trilemma, this will be the decentralization axis. That means if you really want to be decentralized, and remember what we said, the surviving cryptos anyway will have to pass a significant level of Nakamoto coefficient decentralization. So there will be no blockchains, no centralized blockchain. This is full of shit. Everything that is centralized doesn't even belong to this thing, okay? So I'm not talking at the base level requirements of blockchain decentralization in here. I'm just calling it for how can you increase and maximize your decentralization? The way it is, that means horizontal distribution. And if so, then are you easily interoperable with the others? Because of course, if you build everything as a vertical extraction mechanism, like basically Ethereum does, then you will be very hardly interoperable with the others, or several trade-offs will have to be made to achieve seamless interoperability. By talking about interoperability, I'm not just talking about cross-chain transactions with counterparty risks and stuff like that. Like, I'm not talking about Oracle-based type of interoperability, like Chainlink stuff and whatever. I'm talking about consensus interoperability, how consensus types can interoperate with others. And to me, there's just one clear winner in this game, and that's the Cosmos DBFT, aka old Tendermint stuff, and IBC type-like client stuff. Though, of course, these things can change, just like I said. Just like Solana will be winning on this axis, that doesn't mean Cosmos will win forever in here, but it definitely seems to me that today they're having a head start in this battle. So that means the consensus are easily going to interoperate with each other, and it is consensus agnostic. That means actually like client and IBC can interoperate easily and seamlessly with the Cosmos DBFT, but it also can interoperate with the others with some trade-offs, of course, but it is really easy integrable into other systems. That's a like client vision of stuff. So to me, that's really the way it goes. If you want to maximize decentralization, you want to maximize horizontal distribution with ease of interoperability. Because if you're just trying to build a horizontal stack that can hardly interoperate with other branches, well, you're basically fucked. That means, well, you're building inside interoperability. That's basically what the layer 2s are actually doing now. But on the other hand, well, privacy can easily be traded off. That means, well, if you do this, you create an easily interoperable network. But the thing is that if you want to remain decentralized, you're going to have to guarantee a minimum level of privacy. So if you're just interoperating without, and by trading off all privacy, then you're not really decentralized. You're just offering horizontal scalability, which is a totally different thing as truly be decentralized. That means you need to maximize these two together. You need to be very interoperable inside and outside of your native consensus. And you also need to be private and offer public, non-public gateways and permissioned environments. You need to maintain privacy, the difficulty to track transactions. And in that sense, you do have the true sense of decentralization. Just like, which we said, scalability just can't be achieved by maximizing TPS and extracting millions of transactions from a single user. That's not scalability. That's just spamming transactions. So on this end, as we've seen, there's no way for this blockchain trilemma to just disappear. It's actually an axis that requires two elements to be maximized at the highest they could be. And in order to do this, there's no other way but to use the distribution that I made in here. And that tells us what type trade-offs are going to be made by each and every leader in each sector. They also tells us how to maximize scalability in a dual system. That means there's no one to rule them all. It's always, to me, going to be a dual system. Just like, to me, Ethereum is the perfect market fit to compensate the lux and the trade-offs that Bitcoin has to make on the security axis. When it comes to scalability, well, so many people tend to say, no, Ethereum is layer 2s and so on. Well, I don't necessarily think that's the end of it. To me, the layer 2 scalability ends up in this axis of scaling. Sure, there is a relationship with Ethereum, but I mean, smart people already understood that this verticality that is Ethereum to its layer 2 is not just as vertical as people think. There will be a lot of value extracted by these daily active users onboarding systems, even though I personally think this area will be dominated by layer 2s. On that end, if they do maximize daily active users, they just can't trade off transactions per second. They're going to have to be quick and fast execution. That's what we see now with the sequencers battle and who's the fastest and so on and so on. But they still have to rely on other trade-offs. Are they going to afford average transactions by the trade-off they made? Are they going to maximize the value locked inside their layer 2 ecosystems and so on? They're also going to have to trade off interoperability and privacy. And that tells us, to me, when I follow this model, if I look at it, I'll tend to say what this model teaches me is that with the help of these lenses, I can actually say, to me, the winning layer 2 is going to be the one that perfect fits this system. That means it will maximize daily active users, be the best one at onboarding users and retaining those users. It will also have to maximize extracting transactions out of each individual thing, but not necessarily trying to be as performant as the leader. Remember, the difference market share in here is significant. It's pretty much one single to a double. So it's really significant. That means you're not trying to eat away from the Solanas and the like. You're really just trying to still onboard your user and make them do and perform transactions on the network. You're not just trying to maximize the clicks, okay? Because what you do best is to give them the most convenient user experience. That's the way I would say. So for layer 2, that's what this model says. You still have to maximize this, otherwise you don't belong. The thing is that, well, you also know that the number 2 trade-offs where you're going to be the least performant at is going to be next to your maximization points. So that means you're going to have to trade off interoperability and the total value lock. That means layer 2 will hardly be able to store value, and they will be very, very badly and poorly interoperable between each other and between other ecosystems, or at very significant trade-offs. I think the value that will be in layer 2s will stay into the layer 2s. That means less than 1% of that value will transfer to other ecosystems or interoperate with them. So to me, whatever is in the layer 2 will stay there. That's the sequencer version. That means, well, I have everything built in. I will make you comfortable home and you will stay there. You will not really willing to go elsewhere. That's really why I think every layer 2 that's trying to say, okay, we're going to give you the ability to go everywhere else, that's just not going to make it to me, because that's the number 1 trade-off to make. Okay? You want instead to build a comfortable home with diversified activities inside the system and the same centralized sequencer to do this. Okay? On the other hand, what you can see, it's hardly going to convince investors to store value in this network. But it still means that for the good ones, they will still willing to have high net worth individual performing quite significantly big transactions inside the ecosystem itself, but the value won't stay there. That's what this thing tells, okay? Big transactions, but the value won't necessarily externalize. You won't collateralize the value that you have inside that system. If you want to get it out, you will just get it out. That's really the way, or get it elsewhere. What it tells is that, well, on the trade-off, it's still going to have to maximize privacy. Though, in my humble opinion, any layer 2 that doesn't guarantee a significant level of privacy, we're talking about 3% market shares in here, so there's going to have to be privacy requirements. So it's very important for layer 2s to figure that out. But on the other hand, well, we've just mentioned those 2 axes, okay? We've just explained the distribution of value that there will be for the security axis and the 2 different trade-offs that need to be balanced according to the others. But to my humble opinion, there's also a timing axis that needed to be understood with this. First thing that we've cared about was the most value extractive, that was security, because that's the whole purpose of potential verticalities in the ecosystem, or store of value, which Bitcoin is. Well, in that sense, to me, that's the first 2 elements that are going to be checked in this list. Like we said, there are hardly chances for Bitcoin to be taking the lead upon another asset. Same thing to me goes for Ethereum. Then that means on the previous cycle, we've seen venture capitalists putting hardly an incredible amount of money into the Solanas, and now layer 2s see tremendous investment. So I tend to believe that this was like the 2018 cycle. The 2021 has just been confirming the leadership of those 2, and I would say 2021 has been the venture for scalability, and it's going to confirm. That means to me, the winners will be settled by the next crypto cycle. God knows how long it will take. If we're still going to behave to the 4-year cycle of Bitcoin, still to me a discussable, something we can really, really deeply argue upon, because now it's not just Bitcoin. But still, let's assume this is. By the next cycle, I think this one will be solidified, and we'll have clear winners, or at least lead takers on these two market shares. That leads me to believe that if we do follow that sequence, then that tells me that the venture on the next cycle will be this, will be on the decentralization axis. That means, well, the other two, they will have to have made those decentralization trade-offs, meaning that in order to maximize scalability or security, they will all trade off a bit of decentralization. Remember what? Because when you have 0.5 or 0.6 and 0.5 there, okay, there are of course lesser point to distribute. So there has to be a decentralization maximalist area in which I tend to believe that, according to this model, will be distributed to two axes, one with interoperability and the other one with privacy preserving. Though there will be one that will maximize cross-chain transactions by still enabling privacy. Those who just do cross-chain transactions without privacy will not work. Remember, the one that has 6 points in here needs to have 5 there. Okay, and same for the other one. There's going to be one that is highly private and that export its privacy elsewhere, has a lot of interaction with Bitcoin, Ethereum, layer 2s, and so on to bring privacy as a service, okay? Just like this one to me is interoperability and those security as a service, okay? So that's really the way it goes. This is where I think there is Atom, and this is where I think there is Monero and its ring signatures. So we'll talk about that, okay? But anyhow, we also know by this model which type of structure and trade-offs these guys will have to make. Though this thing tells for the interoperability layer, what we're going to have to be talking about is that, well, of course, 6 points here, 5 points there, that's the guarantee we know. We also know that 1 and 2 will be next to the 6 points. So we know that there's 1 in here, though that means the interoperability layer will hardly be good at bringing in daily active users and will be very bad at extracting value out of a transaction. Kind of makes sense to me because I've built an entire report on actually the Cosmos ecosystem as a use of a potential B2B2C system. Basically, to put it mildly, that would be, I think, the Cosmos tech stack is going to be the MySQLs of businesses today. They create databases and shared databases, but on the blockchain version to make them natively consensus-based interoperable. And in that sense, most of them will probably use a Cosmos DBFT type stuff. The beauty of it is that in this report, I highlight all of the privacy features enabled by the Cosmos tech stack, which of course no one pays attention to today, but they will in the future. The thing is that, of course, if that's the winning tech stack, then it definitely does maximize privacy. It's not just as good as ring signature, which I tend to believe anybody who's willing to have privacy will just, go for the most private asset in Earth. That to me is just, this is XMR winning by a large margin in here. So I tend these two to be confirmed by the next cycle, but to be venture. I think there will be venture capitalist investment into Monero, whether being securing the network itself by running decentralized validator on it, or by doing it the same thing as providing security as a service through a Cosmos-based network of B2B, which I highlighted in the network, in the report that I've shared. I'll put a link in the description. So that's really the way it goes, okay? Making it very, very easy. If you have that, well, you know that the trade-off is definitely user onboarding. This thing, they will not have daily active users. It kind of makes sense in a B2B2C system. Well, the users are going to be businesses. That means there are very few of them, and they don't necessarily interact with the end user. The businesses putting their databases on a shared blockchain-based version, they will require privacy. Most of the data will be encrypted, and there will be very users to interact with it directly. It's just basically databases that will be shared privately and permissionlessly between different businesses. That's the B2B2C system. Though, on the other hand, we also know that the average transaction value is very likely going to be a trade-off as well. That means, well, to me, that is the one that makes the most sense. And you will see that the figure itself is just repeated perfectly across the board. It's just looking the same. It's just rotated through the axis. So in that sense, well, that means, well, very limited high-value transactions will be performed into the system. Still 1% of very high-value transactions will be performed there. What we know as well is that in terms of trade-off, it will be kind of relatively good, 3% overall market shares at doing transactions per second. That's what I see on a Cosmos blockchain. Cosmos blockchain can perform multiple thousand transactions per second, which is very much more than enough for these type systems. So they don't necessarily need to be crazy fast like the Solanas and the layer 2s, but they still need to be relatively fast. Okay, so that's really the way it goes. That means 3% of all transactions performed on each second in blockchain type infrastructure will be performed in these networks. It's still significant, remember that, okay? It's not nothing, it's just there's value in here, it's just others are taking much more significant lead in these positions. The other thing that will be very good at to me is the total value locked. That means, well, more than 10% of the economic value of assets will be stored into these networks. Remember, the horizontally distributed network. That means not 10% of the value is stored in Atom, but 10% of the value might be secured by Atom. That's what this model says. Remember, interoperability economic model relies on security as a service. Everything in here is detailed in the report I just aforementioned. So it's really the way it goes. If you're looking for a crypto that highlights and take on market shares and bring revenues for interoperable tech stacks, that means this is security as a service. There's no other way to extract value out there. This is really the way it goes, okay? And for the privacy, well, you're going to have to preserve privacy for the users and to be highly interoperable with the other networks. That means you need to have ease of connection. And that's the reason why, to me, the XMR's atomic swap with major blockchains to this date are the signs of native integrations of these systems with the others. The native interoperability, I mean, XMR is getting interoperable with the other chains very easily, okay? And that's the way it goes. So I think I will sum it all up now in kind of a shorter conclusion. So this model, of course, been built by myself. So some might just say it's been coming out of my imagination and so on. But the thing is that, well, I still have a bit of experience in trading and building models, such a thing. I think this one is pretty elegant enough, I guess, to be shared to the general public, and it's the reason why I'm making this video. So, of course, you might disagree or think that some dots might have been placed differently. The thing is that, of course, I try to figure out a kind of mirroring and rotating pattern, because that's generally what I like to say, and that's what trading taught me over the years, that, well, these things generally rarely copy-paste, but they tend to rhyme. So I generally tend to like when a model like that tends to sound like a rhyme. It's good. And to me, well, it just makes sense because it organizes things in a logical manner while still, of course, maximizing the specialization of each one. I've always been pleading for a multi-chain future. There's no way one blockchain will end up winning the game. It's just not going to make it, just because basically, smart minds in this world, they figured it out. They pulled it into different wordings and stuff like that. It's just, I mean, this blockchain trilemma is still, to me, a real thing. It's just that it's migrated over time to something a bit more complex. But I wanted to highlight this thing. I think this is the 6-angle market share model makes a hell of a lot of sense. That this horizontal, horizontal distribution trade-offs, that means if you want to maximize one axis, you're going to have a trade-off. And these trade-offs are kind of organizing themselves perfectly only if you have a 6-branch stuff. So that's really, really interesting to me, because this 6-branch stuff is also the one that I've always been using to build power load power type distribution. And in that sense, well, that's really why a hell of a lot of models that I've been very familiar with building investment strategies or trading strategies, they still to resonate with this model as well. I've been using a lot of the knowledge that I gathered over the years, and they all tend to integrate seamlessly inside this model. The generalized kind of rotating mirroring type organization, the power type load distribution for Pareto market share distribution, the 6-angle that replicates kind of the duality of the initial trilemma problems, which still tend to believe to me that it all makes pretty damn good sense. So, of course, make whatever you want with this model. I share it for general knowledge. I hope you'll make good use of it. It's just the model that I follow to figure out who's making the best possible choices to be the leader in its reference market share. If you're trying to be the best at daily active users, then this is what this model says on types of traders that you should do to be the best at doing it. On the other hand, if you try to sacrifice transactions, you're just not going to make it. So there is this horizontal distribution mechanism. You need to be good at both of them to truly perform scalability solutions. And if you do that, you're going to have different trade-offs with the one that is leading on the opposite end of that stick. That's really what this model tells. There is no way, I guess, for this thing to be randomly organized. Because if there's one way this thing can mirror or whatever, it's generally the way the market takes. I don't know why, but that's really what I've learned throughout the years. There's some kind of magic in the markets that causes it to be not just as random as people think. Of course, there is high level of randomness, but not all the times. So here it goes. Bye, guys. Thanks for the time, and see you later.